Audit to the FARS committee meeting as scheduled. Sorry for the slight delay, technical issues. I have requests that we finish this meeting by 3 o'clock today. A few people are going to leave, so we'll see how we go. Do our best. That's entirely in everyone's hands here. Do we have any apologies? I think we actually have.
Oh, yes, Chair. Sorry. Well, if you finish by 3, it's not an apology, but I do need to leave at 3.
That would be a compliment, actually, if we finished by 3. Okay, thank you. Thanks for that, Jackie. If there are any changes and any conflicts of interest, please note them, or presumably you would have already noted them. Item 3 on our agenda is the confirmation of the previous minutes. It's all there in Stella. I've looked through those. There was one thing in particular would bring to our attention. It's in our follow-ups, actually. I have asked the governance team about this in the past. Often we have matters arising or issues arising from minutes. Actually, in standing orders for this committee, it's perhaps a bit quirky. We don't have matters arising, but of course we have follow-ups, which is a way we can address any concerns or issues that anyone may have. Anyway, having said that, those minutes from our previous meeting, which was on the 4th of May, 2022, someone that was there present, have they gone through the minutes and that they're true and correct? Thank you. Good and accurate reflection. Thanks, Neil. Seconded by Stephanie. Yeah, thank you very much. Passed. Any follow-ups to those? Or the items on those previous minutes, which are on our page 3, I think, on our agenda. I'll kick off with just one, less a follow-up than just a comment. Oh, excuse me, Susie, this is your first FARS meeting, isn't it? Excellent. So we welcome Susie Young, new, reading your title there, Group Manager Corporate Services, there to keep us safe, assist us, inform us, and incredibly deepen our knowledge of things FARS. But welcome, and we look forward to your contribution. But jokes aside, we have a great relationship, and hopefully we continue that with people in your team. On the page 5 is where I'm looking at, is the various follow-ups. It was around the item 11, which is around the fees and review of fund managers. I had a chat there. If you recall, there was a general review coming up at some stage. It fell into all things HBRC, and then we thought, well, if we're reviewing, we should see if HBRIC are reviewing as well. And that all made sense. We all agreed to that. We've had a few changes, but I'll just note that we will be reviewing the fund managers. Particularly what's interesting to me is the procurement criteria used as we canvass potential fund managers when we do this review, which we are now beginning in early 2023. I think I just want to note that, and thanks for putting that in there or back in there. I look forward to that. And at some stage, I think we should refresh, perhaps at the new council, those things that the committee are interested in, as well as what you have to do under your normal procurement policies. All things financial are going to come to the fore over coming months, I'd say, as a result of global markets moving around land and our various financial reportings around this table and the tables CNS and, of course, the full council. So I have a fair bit more attention in that. But other than that, that was, and again, thanks to whoever put that together, I think it's captured it pretty well. Was there anything else in there that anyone was particularly interested in? I know, maybe I'll just bring it to you, Stephanie, item 2, which we'd had a larger discussion about the HR type of things, and that fell out of the audit, and you had some contribution to make. Yes. At and outside of committee. Is that an accurate report, and anything you'd like to update us on there?
It is, yes. I met with Leanna Monteith towards the end of May to go through the people plan. It strikes me that the people and capability team is being led by a very seasoned HR professional who knows the work that needs to be done. and I was comfortable with the matters that were raised in the Crow report are being appropriately addressed. And it was good to get across that level of detail and get some comfort around that. It'll be a matter of making sure that that team is resourced and supported appropriately to make sure that it can all be delivered accordingly. And I remain happy to be a sounding board in that regard.
Thanks, Stephanie. That's very valuable. James, you got any comment to that?
No, look, just want to record our thanks to Stephanie for her input and support to Liana and developing what she has brought to this committee and now has to execute. I think it's possibly stating the obvious that the last 2 years have been an extraordinarily challenging time for the people and capability function more broadly, just because of all the things COVID that have had to be managed. But the large volume of staff turnover and recruitment in the last sort of 9 months or so, I think, have really exacerbated things. The good news is that's starting to dissipate and the team's starting to get more space now to focus on the more strategic matters as opposed to just treading water. So I'm optimistic we're bringing back to the committee post-elections a progress report on the people and capability plan that will demonstrate some significant progress across those actions that came out of the Crow audit.
Thanks, James. And yes, there's a lot of things that are landing in that space, which are particularly exaggerated with the turnover in the market that we have and the gaps that you're dealing with, new people arriving or leaving and some turnover. So look forward to that. Well, I guess no doubt the new council will. Roughly when will we touch base back on how that's all going? Or the next report from HR, when will we see that?
I think we could give a report, either written or verbal, to the committee meeting, which will happen before the year's end, after between the elections and year end, which will be called for, amongst other things, adopting the annual report. So that seems like a good time to sort of round out the year that's been on all things people and provide an update then. So we'll put that perhaps as an action item just to make sure that's in the agenda for that meeting.
If you could, yeah, thanks. And also, just a bit of a theme in there, also a kind of a snapshot of where we just all things are, to some of those numbers, and which just shows the challenges that the leadership team have. Doesn't really matter why they're there, they're just there, and the organisation needs to keep moving regardless. So, but as this committee is interested in, is the risks to the organisation from that and how you're managing, or the team at least is managing that. Will or Jackie or Neil, is there anything that's taken your interest in particular on those follow-up items? Things finance will be having a larger discussion about very soon. So if any of those are of interest to you, perhaps just park that thought. But you okay, Will? Jackie, Neil? Okay. All right. So then I presume is that a report we've got to receive, or is it just a noting? We've got to receive. I'll move that we receive and note that report. Stephanie, you're seconding that? Thank you. Passed. Okay. We've got a series of finance/treasury related issues to talk to, and in our agenda there's we've got the quarterly treasury report next. Are we comfortable to follow the sequence as in the agenda? Neil in particular, I know you've got some questions that cross-pollinate maybe the audit, the annual report. No, okay, let's just go straight to the quarterly treasury report. Sorry to muck you around.
Thanks, Chair. So look, I'll pass over to Susie and Chris, but I think we can also introduce to the committee for the first time Jess, who has recently joined the accounting team.
Oh, welcome.
Hi, Jess.
Yes.
Yeah, so Jess Bennett is interim cover for our commercial accountant following Kishan's resignation, and so she's helped prepare this report in here. As I take the report as read, We basically continue to see a decline in managed funds and investments over the last quarter as the rest of the world. So it's seen significant decrease in value of the funds. However, the shortfall in the funds, which we were normally counting on to sort of as part of our coverage for rates in the year, we won't need to replace them with loans, given the shortfall in some of the expenditure and capital and operating in other areas of the council. And just really to noting that in terms of all of our performance measures and SIPO and that, we're all in target with all of that, monitored by PwC, and that we continue to monitor the financial markets and have been in recent discussions with both our fund managers as well, with Susie having started. But at this stage, we're still confident that the investments are well balanced for the longer term. Right, any questions?
Yes, thank you. I think there'll be a few. I'm particularly interested in, the context, we're talking here about HBRC's investments, but of course, below that, we've got HBRIC's performance, which is pretty much reflected in the same way, which affects us. But your para 21, to me, round a table as a director of a company, for example, when I read a statement which says, based on the June funds results and the value above protected amount, the funds held are not sufficient to deliver the returns required to meet the council's requirement. And then you go on to say borrowing will be required to cover the revenue shortfall. Now, I understand that, and that's the short-term solution to that. That's a very, very serious statement to make. Just the wording that you've used there. We do not have the funds as we expected to meet the plans that we've put in place. And look, I fully agree. Much of that's out of our control. But I wonder if you just could expand on that a little bit. I know you've got the table below on 25, which shows that bottom line in particular, which kind of starts to show the shortfalls cumulatively. So not having market commentary, but the risks to the organisation of that, particularly if that continues, other choices or prioritisations that might be required. Any observations, particularly from a finance/accounting point of view, I welcome you to expand on.
I think from a finance or accounting point of view, yes, if the markets continue to decline or don't, in that sort of rate, basis, especially when we have in our long-term plan a requirement to, $10 million from HBRIC and another $6 million or $3.8 million from our managed funds to actually offset some of the rates, the longer-term viability is always into question if markets continue to go down at that rate. I think no one could have predicted what's happened at the moment in terms of equity and bond markets both going down at the same time, and we're sort of in uncharted territories. Realistically, it's a matter of watching to see what happens over the next year. If that doesn't recover, then we as a council will need to make some tougher decisions.
What would be an example of those decisions?
Well, we'd have to cover the funding somehow. If we've got a level of expenditure that we need to actually incur to deliver the stuff that we've said that we were going to do, at the moment, just under half of it is funded by ratepayers, and then there's a good percentage that's funded through these investments. If that's not there, then it's either a burden on the ratepayers or it's reducing the amount of activity that we'd actually be able to do.
Yes, so this will start
funding it from intergenerational.
So I think it's very wise just to contemplate the start decisions or choices that may be coming upon us, or that are actually there now for us. They've hit the ground, and this is as at June, and so we're probably 2 months later now, and obviously things have changed again. One thing though, there was a positive note, which I haven't seen here. You did some pre-hedging for your borrowing program, which therefore must be in the money, from your forecast borrowings from last year, I think. So that's a good thing. And look, we fully acknowledge you don't decide where the market's going or anything like that, but there are implications for us. So, for example, the shortfalls that you described there on para 24, For example, a question I'd have is, if we do borrowing, and therefore we can only borrow for capital projects, I think very short term you may be able to borrow for operational. Where are we at given our smaller balance sheet from the result of HBRICS investments in the port, and therefore this organisation's balance sheet? How's the ceiling we have, our borrowing capacity? It must have been squeezed a little bit because of that and because of what you're forecasting here. So how much headroom do we now have?
The restrictions on our borrowing capacity relate to our rating revenue and multiples of that. So our equity position, as per our net assets, doesn't impact our borrowing. So that's fine, and certainly our borrowing track is well south of what we had anticipated because of the disruptions to the capital expenditure program, which have been covered previously. Can I just make a comment in relation to paragraph 21?
Yep.
Because I think it's slightly misleading as the way it's written. Budget 21-22 was always expected to have a shortfall in both investment and rating and user charge income to meet our operating expenditure, and borrowing was always forecast to cover that shortfall. In the event there's more pressure on the requirement for borrowing coming from a reduction in income from managed funds relative to what had been budgeted, but as Chris said at the outset, we also have a lower level of operating expenditure occurring due to some of the delays in delivering some of the work. So that's offsetting somewhat, and our overall position is seeing less borrowing than had been anticipated. And I think at the moment, I think I'm anticipating year end that our net deficit will be smaller than had been forecast in the budget.
A lot of that is to do with non-spending of forecast items, particularly on the capital account.
And operating associated with, yes, that's correct.
Roughly, what's that number? Not to the nearest cent, but just a...
I haven't seen those financial reports. I don't know whether we're getting a handle on year end at this point where we think.
Excuse me.
But the finance team are working on it right now.
Yeah, they're just going through with all general managers and that at the moment to finalise getting the report for CNS ready.
So just describe the report that's going to arrive at CNS.
We've got the Q4 report coming to corporate and strategic.
Yep.
And that, so at the moment, the management accountants are just working through with the general managers to confirm their results as they stand, their draft position at the moment, to make sure that there's nothing else in there that needs to be accounted for.
Okay, great. We look forward to that. So thanks very much for that. Just one final one from me. You said, and you write in here, you're satisfied that I think the investment criteria or something along those lines is appropriate for our circumstances, or you're comfortable with it. How do you know?
In engaging with PwC as Treasury experts in there to actually, we have a fortnightly meeting with them where they go through what the positions are. They monitor all of our benchmarks to make sure that our borrowing and everything is all within targets, and we work through with them in terms of forecasting what our spend for the upcoming year is likely to be, when we'll need to be able to borrow again, and making sure that that's all within margins.
Okay, thank you. And it's a good point the CEO raised. In our LTP, we are forecast to borrow through this next 3-4 years. It's on the flag, so we're just borrowing additionally to cover these mark-to-markets. That's quite fair enough. I'll just move around the table. Will, any thoughts or comments in this space? Then I'll go Stephanie, Jackie and myself, Neil.
Thanks, Chair. Just kind of following on from that line of questioning around the managed fund returns, and particularly as an investment and what we require from it with council, particularly around the returns and how they offset rates somewhat. Does this kind of blip, or whatever you want to call it, this downturn, and we don't know how long it might go for, kind of bring about a need for a conversation around, are we diversified enough, but not just diversified for the sake of it, but around the way investments function. So if we look at the property that's mentioned there too in the report, they're talking about it, the valuation looking better still, which I'd question that because Wellington as a region is leading the charge for the downturn in property values. But nonetheless, the rental yield is the rental yield. So if we own blue chip properties, it can do this, but our rents are more stabilised and therefore provide us kind of more stabilised income to help offset our rates or whatever we want to do with those investment returns. So, yeah, just do you think this current environment and what's happening with those managed funds, makes us need to ask, is that the right investment vehicle for what we want out of it as council?
I think in terms of the work that PwC do, one of the things that I look at is the return that the fund managers are bringing compared to their benchmark, which is effectively if you did nothing with that money and that investment at the start, they're both outperforming their benchmark in there. So in terms of having that in the managed funds, it's doing better than if we weren't doing anything at all with it. In terms of putting all your eggs into one basket or stuff like that, that wouldn't be a good option just because property may be doing better at the moment. As I said before, the equity and bond markets both going down at the same time is not usually what you would see in there. So it's a bit of an unprecedented territory for everyone at the moment.
Yeah, thanks.
Thanks, Will. I should have invited Susie to speak, so
Oh, no,
apologies.
may,
Susie.
yeah, sorry, thank you.
No,
If you don't mind, may I?
normally used to people butting in.
May I just
Sure,
respond
like I do, don't
in
worry
relation
about it.
to your question, how do we know we're happy with it? And I think observationally really early on in this role, I think we are at a time now where we possibly need to think about the investment strategy that HBRC has and HBRIC. We have a statement or a SIPO, our investment proposition with these fund managers, and it is the same on both sides, but both entities have a different requirement to pay back dividends and or returns. So there is definitely an opportunity to look at that SIPO. For example, we are really risk adverse in what has been set, and that's been some time that's been set in motion. Observations early on are 25% of that SIPO we've got invested in global bonds. Now, global bonds are returning negative, and also another 20% in New Zealand bonds, so they're 2%. So if we need 6%, we're actually nowhere near what we need, and we've set that ourselves. So there's definitely an opportunity to look at those SIPOs, because if we need to generate more income off those investments, then that's what we need to do. Fund managers will do what we want them to do, so we need to instruct them if we want them to do something different.
Thanks very much, Susie, and also how much we leave with fund managers
Correct.
as opposed to our capacity and competency within our organisations to deliver on our expectations. You're exactly right. I think I, for one, would welcome that. I presume Neil would as well, and my colleagues on HBRIC. There's a lot of work to do, and this brings it to the fore. So thanks very much, and please give me a flag at any moment if you're adding value to us all the time. Don't worry about that. Stephanie.
Thanks, and that's good to hear in terms of having a look at the SIPO. I think I've said this before around the opportunity to take profit, if you like, in the good years and to, or at least to preserve some of that capital, so that in the leaner years, when there will no doubt be those market downturns, there's at least some form of operating costs set aside as a potential. But no, I didn't have anything else to add other than that.
Okay, just one thing. In our report, I think it's PwC's report, page 19, we talk about the various funds, their returns net of fees. For example, last quarter, down 6.1% on our managed funds with one of the organisations we're with. What's that number gross of fees?
So it's probably something that we'll need to go to PwC to ask for that and bring that back.
Okay, that would be good. To be honest, I'd be surprised if they told us that. But my point being, the ratepayers' balance sheet has decreased for a number of reasons, and the question I would pose to us is, are we doing things as efficiently and as effectively as possible? Fees contribute to our total return, And so there's coming a time very quickly where cash is already king and every cent counts.
Are you going around the table, Mr Chair?
Yes, we are,
You're
sorry.
having a shocker.
I am. Where's that other chair? Jackie?
Thank you, Chair, and Susie, thanks. I'm so pleased to hear what you've said. It's really reassuring to know that you'll have a really good look at the investment strategy, because going back to what Will said earlier, you did, but it said that if things were a bit stagnant for a while, why is that? Can we actually resolve that? And the very fact that you're reviewing fund managers in early 2023 is a great step. Bit delayed, but it's still a great step, and it just means that you're having a really good look at our investments and are we invested in the right places with the right fund managers. So really good to hear. Are we making comment on the property investments as well in this paper?
You can, it's reflected in there, the leasehold portfolios in there. and
Before I
Wellington's
get
in
to
there.
that, I did have a question actually. Now, in the report on page 22, it's just about moving significant amounts of money. So go to the bottom of page 22 with the bullet points. Total capital invested in the HBRC PFIF. There's all the information there, and an additional was transferred across. Just a question, and that was in June 2020. And then, of course, June 30th of June 2022, also more money was moved around. I just had a question as to who is making those decisions about moving that money.
So my recollection is that they were council decisions at the time.
Okay.
I'm just struggling to recall precisely the reasons. But all of those significant movements around the portfolio have been authorised by council at various points in time. So,
Okay, and do we get advice as well from fund managers? Just going forward, I just think this is a big amount of money.
certainly when all this was set up, so we had all of council, I think, from memory, involved in the procurement of the fund managers. We had a pretty extensive process of interviewing them all. There was competition around fees. All that stuff was thrashed, and we went quite wide across the market. And council themselves decided on preferred fund managers, and there was considerable advice at the time around the setup of all of this. But what I would reflect on is that it's probably got a little bit into set and forget as it was early in the electoral cycle, and I think post-election we've got an opportunity to have a bit of a refresh with the incoming council about the totality of arrangements here, and make sure everybody's up to speed with what's in place and comfortable with continuing down that path or making whatever changes the council feels at the time off the back of some good independent advice. So I think we'll line that up post-election.
So thanks, and that feeds into what Susie was saying earlier.
Exactly.
Just make sure we pick that up, and it's a further discussion to have, I think, it's
Yeah.
very, very timely.
Really
Councillor-
good. I just have one more thing now around the property. Wellington leasehold, point 32. We are valuation advice is that we can expect another significant increase in the portfolio value when it's revalued as at 30th of June 2022. When do we expect to receive that valuation?
They're being done at the moment.
Okay, so
And
that's all.
that's as part of the annual financial statements.
And given, look, we don't know what we're going to expect, but given the current property environment, should be expecting a higher value still?
So it's a higher value as compared to last June.
Yeah,
June
true.
2021. And so there was a significant increase up to December. There has been a downturn since then, but I don't think it's as big as the increase that was happening. So we're still expecting an increase in that.
We have just had a recent, couple of the properties return back individual valuations for the purpose of renewals, and they have increased on last year. So that's indicative.
Mm-hmm.
I think it's generally true to say that the commercial property sector hasn't suffered to the same extent as the residential in recent times, particularly in the Wellington region. Government continues to put upward pressure on supply of commercial buildings in Wellington, so it's been quite a good bet to be in recent times.
And are we satisfied with our annual returns of rent for the rentals at that value, 841K? Are we feeling satisfied as a council,
And
that kind of return?
the annual rentals are based on valuation at the time
Yeah.
that the rental is done on either the 7 or 14-year lease term. So the ones that we are going through and revaluing at the moment where the leases are coming up, their rentals are increasing quite significantly. So we'll be more satisfied once all of the lease reviews have gone through.
Neil, thank you, Neil, for your patience.
Yeah, welcome, Jess. Are you, the comment was that you are, you're only short-term, or are you permanent, or what's the?
Just interim at the moment to
Interim.
help us cover that role, and had a bit of a handover from Kishad while
Sure,
we...
but you're staying with HBRC, I take. You're,
I hope so, yeah.
right. Oh, it was unclear whether you were sort of just a temping scenario, but you're on the team? Great. Just, can you give us half an hour of the background?
I'd like to introduce you to Mr. Neil Curtin.
Yeah, I'm a chartered accountant, so 10 years qualified, have worked in public practice, commercial banking with Westpac, and more recently private enterprise and property development, investment and real estate,
Right.
a local firm. Yeah,
And most importantly, where do you live in Napier?
I live in Napier South, Shamrock Street, one of the very nice
Right, that's a
areas.
saving grace.
Bit of conflict of interest. Mr.
Look,
Curtin, you really wanted to get
thank
to your
you,
finance questions.
Thank you, Jess. It's good to have you on the team, and you get the first meeting free, and then we put you to the sword after that. So,
Right.
so welcome aboard. So you're the author of the paper?
And
You are good. Can I take you to page 9, summary of the HBRC debt? That's at paragraph 18.
yeah.
Got that one in the paper?
Yes.
Yeah, I just want to be clear on what you've got two columns here: HBRC only and HBRC group.
Yeah.
Now, is the HBRC group inclusive of HBRIC? Is that how it works?
It's excluding HBRIC, the HBRIC loan, but it is including
Sorry,
HBRIC.
no,
yeah.
the opening debt, etc., and total borrowings. Is it when you refer to group, you're
Yes.
talking HBRC plus HBRIC? Is that correct?
Correct.
Okay. I just want to understand the total borrowing, how that occurs. You say you've got the 16 mil on HBRIC coming across from HBRC, so they cancel each other out when you get to that bottom line. So your net position, the actual net across the group, is 46K. Is that
Correct. Yeah.
okay? Thank you. Just want to go to paragraph 20. Council budgets separately for revenue from directly held managed funds, and been having a discussion with Susie about this, but where is that budgeted separately? Can you tell me where HBRC budgets?
So it's those percentage points above for the managed funds, so a total annual return of 5.16% from the managed funds, and
Sorry, start me again.
so just in
If I go to the annual plan, where do I see it budgeted?
It'll be included as part of the overheads, which then go through into all of the groups of activities.
So you won't see it broken down in the annual plan as such. It's at the operational budget that sits underneath that level of granularity.
So it's a revenue
If
line.
it's in the revenue item, is it other revenue? And then if you go to the note, there will be
Note,
something about
note.
interest and...
Yes, it's got note 2. It means note 3. But if we go to other revenue, we've got dividend there of 10.497, which is the HBRIC dividend payable. We've got interest, and this is where we needed clarity as to
Annual plan, Neil.
I'm sitting on the annual plan.
Okay, right.
So we've got revenue, we've got interest revenue of 6.139 mil, and the assumption is that 6.1 mil revenue as a reflection of the return from the investment portfolio, is that correct? So where would I find,
Interest, I wouldn't.
So
So the
terms-
10.6?
where would I find the council's budget for separately for revenue from directly held managed funds?
It'll be a combination of the dividends, some of the interest that's in there, because obviously from the managed funds we're recording that
So you're
income,
recording it as interest.
interest and dividends. So there's 6
Well,
point.
you've got dividend, under other revenue, you've got dividend, then you've got another line called interest, leasehold rent, forestry income, and then you've another line called other income. This is in the annual plan. So I'm not clear, and then it gets
Do you
down.
want to know exactly which line?
Well, I want to know
any
what the
income
I want to
from
know what
managed
the
funds?
number is for the budgeted revenue from directly held managed funds.
So I think we need to come back to
That's
you.
the interest income shown on the notes. So the managed funds income, regardless of its nature, appears in the annual plan as the interest, and the dividends is the dividends expected from HBIC.
Sure.
Can-
So
sorry,
therefore,
sorry, hold on. Could you come to the table, please?
so going to the interest revenue line, I'm assuming and I know we've got, 9 million in cash deposits. So where does that interest get recorded?
That'll be accumulated into that, so that any interest from cash deposits we have will also be included within that interest line in the
So it's
other
part of
revenue.
6.1 mil?
Yeah.
Right? Okay. That's good. I think we need to differentiate it in the accounts somehow, so we're clear on that. But then turning to paragraph 21, we've got a comment there that we're actually not going to return anything from those investment funds and cash.
We're not going to take out any cash. There have been returns, so in the actual financial statements for this year, you will see there will be revenue and dividends which have been received within the fund itself,
Yes, that's
but
correct.
we don't actually
We
take
haven't
any money
realised-
out, so there will be some gains there
So
and there
that'll
will
be
be
a
some
gain or loss
losses.
on investment.
Sorry?
That'll be a gain or loss on,
Yes.
loss on investment.
Well, there will be different things because of the nature of the funds.
Sure.
So we will show some interest revenue and we will show some dividends from those managed funds.
Sure.
We will also show some gains and losses and some fair value adjustments.
I hear you, but nevertheless, we're short of a number that tells us that the expectation or revenue expectation from assets under management will be X.
Excuse me, Neil, just for clarification, you're particularly talking about the first sentence of paragraph 21, aren't you? You're saying that says in the budget there's a line there which says there's a number of 3.7 million of those expectations from managed funds. Is that what particularly?
No, I'm just, where I'm left, I can understand how it's constructed, but what I'm interested to know is what the expectation is as to either a cash return realised and or a gain or loss on investment, what the actual number is from assets under management.
You're asking what the budget was in
Or
the,
what the number is, yeah. And it may be wrapped into it looks as though it's wrapped in interest, other revenues, other incomes out, but and or the gain and loss on investments.
Yes, so the annual plan budget doesn't differentiate between interest and gain on investment.
I'll go back to it. Do we know the number?
Do we know the number for the end of this
Well,
financial year?
Do we? Well, I'm led to a conclusion that we've got a budget figure for revenue from directly held managed funds.
Mhm.
What is that number?
6 million.
Can't be.
Can you explain? You obviously see a discrepancy, or we need some further explanation.
We just need clarity because you've got cash investments of 9 million. They return something. You've got reserve funds. They return something. Is that internalised in the reserve fund or?
The reserve funds are internalised.
Okay. So going to cash held, of 9 million, we should expect some revenue from that, your interest revenue.
Yes.
Okay.
There
So
will
that's
be,
a number.
and that'll be about, I think that for the whole year that we've just had is probably about 70,000 in interest revenue.
On 9 million?
Well, it's only been only at certain times that we have that much money sitting in the bank account. And sometimes it is significantly reduced for that. We don't leave it sitting as cash. We will either have it as term deposits or it's been spent. We don't keep generally 9 million sitting in the bank account.
All right, I think I'm there now. So the bottom line is the vast bulk of the 6.139 mil recorded under interest
Yes,
is the assets under management return,
correct.
which can be a combination of either cash realised or a net gain on investment.
Yes,
Okay, thank you very much.
right.
So you've taken comfort from that? Anything you want to follow through on?
Yes, it does, because it leaves us with the assumption that we're going to return 6 mil when the statement at that paragraph 21 says we're not going to return anything. So have we got a hole of 6 million?
There's, depends what sort of hole you're looking for. Is it a cash hole or is it a accounting hole in terms of what's being reported in the accounts? So cash we are fine because we've borrowed to make sure we meet our cash flow, and our debt is 20 million down on what we expected it to be this year. For our funds, there will be some revenue showing from those managed funds, which would be getting towards 1 million.
Okay.
And there will be 9 million or so of unrealised losses.
Okay. So is the hole I'm talking about, as you've described in paragraph 21, borrowing will required to cover the revenue shortfall?
Yes, but that is also that will also be cognizant of actually how much we've spent, because at the moment, of course, we've had significant underspending in the capital programme and so on. So how much of a hole there is something that we're still working through to present in the final accounts for the annual report. But we are...
It almost said that, yes, we have to borrow to cover the shortfall and then what we were expecting to get a return in there, but we haven't had to actually borrow the cash because we've got an underspend in operating expenditure. So as a council, we haven't had to borrow more, but to actually cover what we were expecting to have as return from these, we did need to borrow in there. Although you're looking at the same thing, if that $6 million that we had as a budget was just as unrealised gains on the managed funds rather than cash coming into.
So there are a whole lot of moving parts that fall out of answering that question. And whether it's borrowing or whether it's a correction in service
and overall,
delivery.
from an accounting perspective as well, I did send some figures to Susie that our Wellington portfolio has gained 4 million or 4.3 million. The Napier portfolio has gained 4 million over the year, which of course, from an accounting perspective, will show, and it's a totally different perspective if we're looking from an accounting to say, actually, we've got these other sources which have done very well and far better than they were budgeted to do. So we were budgeting, I think, 3 million or so gain on those portfolios.
But it doesn't pay the grocery bill though, does it?
No. And neither does money sitting in the managed funds gaining 2 to 3 million that we're looking at as holding it. It's actually what's coming in as cash is what pays it. And that's what we're managing through the use of debt.
All right. Well, just sorry to occupy a lot of space, but we need that.
You don't occupy much space at all, Mr. Chairman.
We need to have a fair summation, and I'm hoping we can get that at the corporate strategic on the 23rd, for us to understand what the nature of our position is. So you've got a balance sheet issues as you describe it. That's not significant. It's the cash position and revenue scenario, revenue and expenditure consequences of where we are today. I had in my head that we needed to find 3 million, but by this assessment, I think we're probably closer to 6 million. Somehow, either by borrowing, change of direction, change in service, etc. But that's just me top of the head stuff. So we need a clear picture of what that looks like.
So would it be helpful, sorry, James?
So just trying to understand, so we're talking about the year completing.
No, this coming
You're
year,
talking about the year that's coming.
current year.
So you're assuming that based on current market conditions that we're going to see a shortfall.
Well, this
in the
paper
year
tells me
ahead.
that that's the case.
This paper, I believe, largely refers to the current status. So where we're going to be in 11 months' time.
June 30. Well, kind of be. Maybe, actually, we're almost speaking at cross purpose a little bit. When you're speaking revenue in your terms, you're realised and unrealised.
Yes.
Which has got to be always anchor that, realised and unrealised. So it's not the checkbook, it's not the balance sheet, it's both. It's one's a sub of the other. And then, so as far as investments concerned, I think it'd be really interesting, but again, may feed into this. I'm not sure you realise what you've taken upon yourself here, Susan.
No.
Is to pick up Neil's point, a picture of the investment performance of the organisation and its subs. Just that. And there'll be a balance sheet, a realised and an unrealised component. And if we had that right there, then the discussion that Neil's particularly interested in, I think it would be very obvious because those numbers the two of you reflected upon will be there. And then there's the council spend cash balance sheet / cash position, and which is also positive because you haven't spent as much as you thought. I didn't realise it was as much as you said. You haven't borrowed 20 million you thought you were going to. And then there's a number running along the bottom. That one plus that one is actually the number in the reports we get, but we keep having to try and decipher them. So if we just take that on board, but then there's just, I think we need to really sit down and think about this larger piece of work, which is the appropriateness of our setup, our ambitions and settings for the organisations, of which everything here is a subset because it's reporting of and the requirements of the organisation. But to be concerned about the council's cash position, but to concentrate on their balance sheet position, and then over what time? Because in our LTP, we do say, for example, HBRIC to go to 600 million, which is a 6% compounding over the next, by 2030, I think it is. Seems it's a pretty big mountain to climb at the moment, but so be it. And then this organisation, then that'll affect our rates, blah, 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 blah. Is that, so we're touching on another piece of work, which I think we should contemplate, and maybe at CNS as we further this conversation. For the CNS reports that come subsequent to this, are you able to just do that separation of the total investment side as the group? That's fine. And then your comfort of, hey, but we haven't spent as much, so our cash position isn't bad as we thought. It's obviously very important, but to get a clearer picture of the assets at risk.
We'll take that on board and see what we can.
Okay, I'm more than happy to discuss it further with yourselves and obviously Neil, and what may come out at the CNS meeting in 2 weeks, I think, whenever it is, 23rd or 4th. Is that helpful? Neil, you comfortable with that? Any
Sure.
observations?
No, it's I just want some clarity around how big the issues we're dealing with are, because we've got, and essentially you've got in this paper on that second table, that paragraph 25, we know we've got at 30 June we've got 104 mil of invested investments out there. You've budgeted 6 mil, so 6% return on that. We know we're not going to get that money because we've also budgeted on dividend from HBRIC, and we know we're not going to get that either. So we've got to come up with a solution somewhere.
For to 30 June or for next year? Because
Well, that's your opening,
yeah,
right?
so you're saying
You've got
we're 9 million behind.
Well, we've got 104 mil
Yep.
assets under management
Yep.
with HBRC.
Yep.
We know we're not going to achieve a 6% return, a la the 6.1 mil. That's budgeted in the revenue line.
Well, there's 12 months to go, and I think,
Sure.
so we don't know.
Okay, but
Yep.
what we're projecting, and it's stated in this paper, is that we're unlikely to do it. If we're going to preserve the capital, we're unlikely to realise or seek to realise anything from those investment funds.
Because
So-
we're
so-
9.7 million behind the protected value
That's
of,
right.
of the total. So
Sure.
we've got to make that up
Yes.
to get ourselves to a
That's
position where we have effectively
Yep. That's
fulfilled
fine.
the policy.
So on our revenue line, we've got that 6 mil shortfall coming there, and I can tell you, because we know from the HBRIC side that the dividend is at risk as well. The 10.5
Yeah.
mil dividend from HBRIC is questionable as well.
Yeah, although I think we'd like to think that the port is still operating, and I think the indications are that their dividend forecasts are broadly in line with sort of last year. So,
Yeah, that's okay.
down expectation.
Sure.
So we might receive 8, not 10.
Yep.
And our managed funds, we are going to continue to receive, income from fixed interest portion of the portfolio. Plus, we get dividends from the equities. So it's going to flow through. But in terms of the I guess the total value of the portfolio, because we have lost so much value in the last 12 months, we've got a lot of make up to do before we're at a point where we're comfortable that the total value of the portfolio has been protected, given the 2% compounding expectation on that.
So what?
But we will still have income.
Well, yeah, we will have it, but at the moment, potentially, we've got a question mark over about 8 mil of revenue, one way or the other. So we need to know what that looks like, and secondly, then to come to some conclusions about how we potentially can manage that.
Look, I think our advice to you is that because of how far behind the borrowing track we will be at year end.
So that may be one answer.
June 22.
That'll be one answer. There'll be several other answers, but
Yeah, I mean, one of the constraints we have under the Local Government Act in terms of the planning cycle around the long-term plan and the annual plan is that we don't have the ability to say drop a level of service or drop a service without consultation. So the annual plan for the year that we're now in, obviously a month in, is kind of locked and loaded to some extent, and we'll certainly do what we can to manage costs through the year if we've got falling income. Having said that, we've got loads of borrowing capacity, and we've got the...
yeah, sure.
Yeah.
So these are all options that help us manage this potential.
Yeah, I mean, unlike, we've discussed this previously, unlike a normal business that might try to trim its sales as it goes, as income fluctuates, local government, much like central government, works on a much slower planning cycle where you consult on the delivery you're going to give the community. You make sure you do that within prudent boundaries so that if income doesn't meet expectations, you can borrow your way through and still deliver the services. And then you make decisions, obviously, about changing activity on the long-term plan, on the longer cycle. So,
Yeah, it also sounds like you're suggesting asking of the council to engage with HBRIC, just so there's a calibration of expectations and what HBRIC thinks it may be achieving over the coming year. Do you think that may be helpful to satisfy some of the things you've just said?
The council give an instruction to HBRIC as to how it wants it to progress to meet its
Yes, but this
cycle
committee can't.
obligations.
Yeah, but it may do that. There's a fair way down the track. But in the meantime, for exactly your point, there's LTPs, there's what's written down at 10.2, I think is the divvy, versus HBRIC may or may not have thought, doesn't know if it could achieve that, or if it does, it may have to borrow to pay that.
Sure.
So can we just take that as an action? Probably Susie your lap, I think Susie, doesn't it? And so you can hear there's so important in this, just everyone's talking the same language at the same time. Okay. So thanks everyone. That's a really helpful discussion. I would fully expect much of this discussion to be repeated or in another form when we have more colleagues around the table. So some of the issues that have arisen, such as just show us the investment side, the cash side, etc., I think will be very helpful in that discussion and the implications, your thoughts and advice as to what it means for the organisation over the coming years. So really appreciate it, and thank you for your intervention. We found someone who was watching us on
Facebook, yep.
live, 4,000 others. So having said that, we've got two recommendations there that we receive, the quarterly report, Treasury report, 1st of April, 30 June 2022, and that we, well, this is true, we confirm that the performance of the Council's investment portfolio has been reported to the subcommittee's satisfaction. I'll just leave those as they are. Given the questions, we just may please take on board where that's coming from so we don't have an argument about if we're satisfied or not next time. But anyway, I'll move those as they are. Can I have a seconder, please? Jackie, thank you very much. Moved, so be it. Thanks very much for your help. And welcome again, Jess. Okay, number 6, asset management review, group review. Chris is there. So,
Thank you.
cheers, Chris. Context of this, am I right? This fell out of internal reviews. That's right.
That's correct. So there was a suggestion that we look at the asset management function as part of the internal review. Look, it was my view that in the last 4 years, well, 4 years I've been here now, we've been through a fair number of management reviews and improvement processes.
Just so I'd like to suggest that we look at this in conjunction with, is it our internal audit plan?
Yes.
Yeah. So item 6 and 7, this fell out of item 7 a while ago, and then you've given us a report to talk to. But just treat these as almost one item, if we could, committee.
Yeah.
Sorry to cut you off there, Chris. Go
No,
ahead.
so look, my plan was to provide a bit of a presentation to ensure, I guess, everyone had visibility of what had been happening with asset management over the last 4 years, and perhaps there is a bit of a gap in the visibility of some of those improvement actions. So I have put in my paper there to improve the visibility of those actions, to incorporate them in some sort of regular report to ensure it's fully visible to council. What I wanted to do was just really step you through our plan in terms of asset management, some of the reviews that we have done, and some of the actions and where we are at with those. So that'll probably take about 10 minutes or so, then happy to have a bit of a discussion, because it's been a very busy landscape and we have done a lot of benchmarking against the standards. So
Thanks, Chris. And thanks. Please don't take us too far down into the weeds, but as you're going through the 4 or 5 that you see you've done, just note the ones that we've seen as either this committee and or a council to further the discussion.
Yeah.
Appreciate it. Thanks.
Chair, on that, and I think just before we get into this, there's a general backdrop comment I'd like to make, and that is that historically the executive team will have and certainly has undertaken various reviews of functions to ensure that we can deliver on council's expectations with respect to the long-term plan, annual plan, and the activities that we're required to do. That's something we do as a matter of course, and see that very much as a key function of management to ensure that we've got the right assets, the right systems, the right people, right processes, right structure, etc., to deliver for you. Now, we have tended to do that at our own behest on occasions, but what we've recognised is that the internal audit program has grown in recent times, and the work of this committee has grown in recent times from what was previously a pretty narrow function around annual finances, with audits around financial processes, to now looking at council services and functions. And obviously the CRO internal audit program has grown over time to have broader scope. Additionally to that, we've got the Section 17A requirements of the Local Government Act for reviewing, and what we haven't done is bring all that together into a consolidated program of work that has consistent visibility of this committee and council more broadly. And I think the opportunity is that we do that, and so just acknowledge here that this is one of a number of areas where we've undertaken operational reviews, hasn't had good visibility necessarily with council. I mean, it's been, I think, mentioned and passed in various different fora over time. So today's conversation is a check-in. If you still want to do something with the CRO contract and relationship to asset management, that's obviously for you to determine, and that's fine. It was just important that in having a discussion around that, you're well informed about what has already taken place and what is currently underway, and what we will bring back post-elections that Helen and I have been discussing is a structured work program which Olivia is pulling together at the moment, that for the next triennium, in 3 years, will map out our proposed program of work around Section 17A reviews, operational reviews, so that you can see the totality of how we are moving through the business over time and ensuring that we're delivering as effectively and as efficiently as we possibly can. So just a bit of backcasting, hasn't been as structured as it could be, will be going forward, and today's, I think, a good example of kind of how the reviewing has and the continuous improvement in the organisation has been ongoing, but not always under the auspices of this committee.
Great, thanks, and that's very, very helpful and forward-looking as well. So that segues straight into yourself, Chris.
So I'll keep it pretty high level. So
8.5 minutes left now.
no worries. So some of this you've already seen as part of the LTP workshops, and I've updated it in areas. But the key point here is we actually work to a number of defined processes. So all the benchmarking work that we've done is really against ISO 55000, which is the standard for asset management. So we're not trying to recreate the wheel. It's very robust. This was just a reminder of the activities that we carry out as a group, and we've just been through these in this morning's workshop. You'll notice that consultancy services is crossed out because that's a service that we stopped providing because of the busyness of industry at the moment. We felt it was worth focusing on our internal work rather than providing resources to do other councils' work. So that's something we closed down for now to focus on our significant challenges. A few numbers, again, we've just been through this this morning, but effectively around $215 million worth of assets of a wide variety of classes all over the whole region. Providing a tremendous economic value in terms of the protection of horticulture, communities and industry. So it really provides a value for money proposition. And just to remind us, in terms of our flood control scheme in blue, our 9 drainage areas on the Heretaunga Plains as the local schemes, then to the Upper Tukituki scheme and a number of small schemes from Parongaho up to Wairoa. So we're really across the whole region. And again, covering a bit of ground from this morning, a whole lot of complexity with how we run these schemes, but effectively the only budget we have to fund these schemes is through a targeted rate and a combination of targeted rate and general rate. So quite a bit of complexity in that. And so these are some of the challenges. One is mobile workforce. We're really transitioning in the last 4 years from staff who'd spent a great deal of their career at the Hawke's Bay Regional Council, held a whole lot of institutional knowledge, to a more mobile workforce, where in fact having good systems and processes and access to information and transparency of that information is really important. So that's something we're working on. We also know that climate change is going to increase the level of flooding in Hawke's Bay, will create a drier environment but more storm intensity, and we're also looking at coastal inundation. So we have a whole lot of new challenges, which means we need to know our assets really well, and we need to have some good infrastructure planning in place. People and assets require a higher level of protection, so we've seen intensification on the plains and in new areas, and there's expectations from the community that those investments are protected. And also, the landscape has changed. There's now not only an engineering view of how some of our schemes should work, but an expectation will enhance ecology, enhance water quality, and meet contemporary iwi aspirations and general community aspirations as well. So that whole landscape has changed to provide additional complexity in our role. And this is highlighted by this illustration here, which really shows going forward high level of resilience and the need to incorporate things like nature-based solutions into the work that we do. So we're not standing still. We need to prepare for the future. So the general approach for asset management was around investing in our people, investing in our processes, and investing in technology, and that really just underpins all of the work that we are doing. And it's been a very busy space in the last 4 years, both in terms of transition of people, developing some projects to document our processes, improve some of our processes, and incorporate technology into how we work. So a few things around people. Significant recruitment in the last 36 months. We acknowledge in terms of our underspend in capital, we need more people to do that, and we've effectively been in recruitment mode there for the last 2 years. Really challenging to get experienced candidates on board. As an organisation, we've also introduced our personal performance development plans and on our third iteration of those, and introduced staff succession for key roles. So one of those examples is incorporating or introducing cadet engineer down at Guppy Road, and also graduate engineers here in the office to develop our talent in-house rather than relying on finding people just in time in the industry. Also developing section plans for our teams and really a mentality of resourcing the program. So asking all of my managers and team leaders, what are the resources you need to deliver the agreed program, and moving away from the approach of this is all the existing staff can deliver. And as part of that, I'm doing some work with the river managers across New Zealand on quality people, which is developing a training and career development program to again invest in our internal people. So this is just an example of how the teams come up with the plan of the work for the year. And this, I just want to comment on some of our capital expenditure, because this would be an area of concern. And we'll look at this in more detail as some of the financial papers for the end of the year come through. But I just wanted to touch on some of the core reasons around that, that under expenditure. When we look at flood protection and control works, that's primarily around our contract with the Crown for our IRG works. Those cash flows were developed during the first lockdown, where New Zealand thought it was going to have some major employment issues through the first COVID lockdown, and that is how those proposals were put together. And they've ended up being extremely optimistic. Where we thought it would be easy to gain those resources and we would be a focus of people's attention, we all know that the market's very overheated at the moment, and we're competing with those resources, which is driving the pace that we can go with that work. Open spaces is really around capacity, and we've made some recent structural changes and additional resources to improve that capacity in kicking those projects off. And the regional water security underspend is about our ability to progress those projects into construction, for example, to tour in the existing environment that we're in. So really just touching on those briefly, and we'll have a deep dive in those later on, but there's just some fundamental reasons driving that under expenditure. This is just a high level, really guiding where we're going in some of our measures, and the fact that we want to have a broad scorecard on how we perform. And so recently we've introduced a new scorecard from Works Group that is not only looking at the financial performance, but some of the non-financial performance as well. We've done a bunch of benchmarking on our asset management maturity, and this is just an illustration I used previously. And it's about what we had in the past was good for those times. So just like the old Land Rover there, it did the job, it got us around, but today it's a bit tired. We need to be looking at the new technology and what's useful for today. But we also have to keep our eye to the future, because we have to keep continually improving. So it's just highlighting really what we have now is the old Land Rover. It needs a bit of work. So this is a summary of the reviews that I've taken the team through in the last 4 years. The first one was a structure review to look at how we could improve our capital delivery. So 4 years ago, we were delivering about 50% of our $1 million capital program. This developed a dedicated team to deliver capital and do some work around our capital delivery framework to be able to have a common language within the team on how we create projects, which projects are delivered by which teams, and some of the process around delivery. So that's been really useful in launching off the IRG program, where we had a dedicated team there that we could expand. Also done a review of SCADA, so that's the remote control of our pump stations, with a bunch of findings, incorporated them into the LTP for additional investment into our SCADA network. We've done a review of our asset management framework, and I'll share those results in a couple of slides. We've also done a review of all of our asset management plans. So we reviewed our 2018 plans and incorporated those review findings into our 2021 plans, and we'll do the same coming into 2024. Also, a Section 17A service delivery review with Works Group, and we brought that to this committee to discuss the recommendations and take those forward. So we've done a lot of work there incorporating Works Group into our organisational financial system. So that's been a massive piece of work. As I mentioned before, investment into a project management framework, and then a second structural review where we saw that within the team, the day-to-day operational tasks were always taking priority, and that was we needed to put some additional focus on our strategic work, particularly in terms of our asset management framework improvements. So we made that separation of operations from strategic asset management. So there's a lot of moving parts in there, and certainly a lot of change, and we're actively working on all those changes now. This is just an example of the review of the asset management plans, where the red is where we'd sort of like to be and the green is where we were. So we used that information to improve the quality all of our asset management plans in the last LTP. And really just highlighting here, it's all benchmarked against an existing standard. This is the asset management framework. So these are some priority diagrams. What it's showing is the areas that we need to focus on is around our leadership, our strategy, our systems and processes, our planning, our collecting and monitoring of asset data, our service delivery models, so how we get work out. So our focus there is on the Enterprise Asset Management System, which is an IT platform that will both define our processes and capture a lot of the information that we have accessible to everyone and supporting mobile computing in the field. So really just starting out on that work with that Enterprise Asset Management project now, which is funded through the ICT program. What that effectively found is some key things. We do have the core foundation documents of an asset management system, but they're not well integrated. And the view of staff was optimistic in terms of the maturity of our asset management framework as compared to objective evidence. So we're working with that going forward. On our SCADA, I won't go through in a lot of detail, but here it really said that we've got a lot of work to do to expand that out, and we had a bit of risk with our internal knowledge around our SCADA system and access to the data historian. So again, working through that. The 17A review spoke about our financial processes, so we've now integrated them into the organisation's financial system. We have a high degree of staff risk, so again, talking about succession plans, and we've got some further work to do around risk appetite. And in terms of their annual contract, that'll be transformed as we take enterprise asset management on board and move away from paper-based work to a more modern method. So this is just around our investment in technology. So $4 million investment into enterprise asset management, which is fully integrated with our new financial system. So that'll make life easy for everyone in terms of how we create I guess, the asset register, all the information around our assets, and how we execute work will all be done through enterprise asset management. So really just talking about that there. So as an example, don't expect you to see this, but this is really a high-level case. At the moment, we don't have a single source of data. We have to look all over the place for our bits and pieces, but the data is there. We're concerned about the maintenance of some of those records, a lot of spreadsheets and bits and pieces like that. It's not easy to get operational information. Once again, it's there, but it's an unwieldy paper-based system. Reporting is difficult and time-consuming, and it's difficult to do asset lifecycle modelling. So that's what we want to change, to have all of our information connected to our asset register in a system that everyone can access and is linked to the financial system. So this just highlights, again, the dark purple stuff is what was delivered through our Fuse project. The light purple stuff is the continuation of those work packages through Synergy. And then this red sort of stuff here and the grey and the blue is what's delivered through enterprise management. So it's all the modules to allow us to manage our assets through the Tech One solution. It's about 2 years of work in there. And this is just really finishing with, in an LTP, what were our priority areas. So again, it was improving our process, improving our technology. At the moment, we have our field staff starting to do their timesheets on mobile devices. So that's a way to introduce them to the technology and progressively wind out more functionality. In terms of a commitment to review all of our schemes. So we're in the middle of our second one, and also looking at consultants who can help us with some of our smaller schemes, working through our coastal strategy, etc., and investing in our regional parks. So that's a quick whistle-stop tour of sort of what's happening in asset management. Because of all that, I really felt another audit of the function would most likely report all of those things that we already know and are already working on. So my feeling was it would be better off deferred until we'd implemented some of that work, but fully understand that you need assurance that everything's working the way it should, and you still might feel that one is warranted. But before that decision was made, I just really wanted to give visibility to everything that's happening, and happy to answer any questions.
Thanks very much, Chris. And yeah, you really hit the nail on the head at the end there.
Yep.
I think we were all surprised when we got your report. I think there's 5 reports in our paper, of which we've only ever seen one.
Yep.
I think we naturally assume all that other stuff was going on, but we have absolutely no visibility other than your trusted word, of course, and James when we in the CE's report. But with hats on this committee, we worry desperately and deeply about things we don't know about. That's the nature of audit. And so I think we obviously do have a discussion. I mean, I'm quite sure you're absolutely right. Much of what you pointed out in your last slide, the enterprise asset management system, stuff that was still to happen over the next 2 years, I think. Let's just say we had some kind of Crow-type audit of your area. I'm sure they will come up with that, and we would have worried deeply about it. So I understand your concern about a diversion from what you think we would have come up with anyway, but we really appreciate your input, but we've got to make that call here.
Absolutely.
But I think we're very much enriched by what you've provided. But I'll note again, this committee, and therefore the council, has only ever seen one Section 17A without the Works Committee. We see it from the larger organisation reports that CE gives us, and we take them as given. But particularly in this area of a lot of issues around things water over the recent years, as you've witnessed, a lot of questions and concerns have been raised about that. They're not specific to you, they're just, we don't know what we don't know. You made one comment in particular, you said you're moving to the other systems to make it easy for everyone.
Yep.
With my audit hat on, I look at, therefore it's hard for everyone now. And so that's a concern from a audit and risk committee. Do you see where I'm coming from on that?
Absolutely. And what we, the findings are very clear, and I've been very transparent there. We just lack the connectivity, we lack the reporting, we just lack a lot of what you'd expect out of a modern system, and that's precisely why we're investing in it. And so the level of reporting and the ability to drill down on certain aspects will be really easy to provide auditors with information. Whereas now it's all there, but you've got to work through to find it.
Sure. Does anyone else have any thoughts or comments, particularly around this part? Then we're going to move to a discussion about what we actually do a third independent audit, feeding off this information or new information that we have. And again, do you want to make any comment in addition to what you said already, James, at this stage?
No, I don't think so.
Just one comment, and you've hired a lot of staff, and we also know that that's quite a massive risk currently in the whole organisation, is staff leaving. So I just want to say well done on getting all your T's crossed and your I's dotted and getting everything in some form of system, because we're going to see that. We're going to see people changing jobs and succession as well. So it's an absolute need, and I just want to say well done for that report. It's really comprehensive for us to have a good look at.
Yeah, thank you. Stephanie?
And on a similar point and related, in terms of those HR processes that you've put in place, it's going to dovetail into a lot of the work that's been going on behind the scenes with people in capability team. Have those processes been in effect long enough to have an impact on your turnover yet?
So turnover is relatively high, and that's due to just so many opportunity for engineers and scientists and everyone else in the current climate. So we have got one story where we have got a success through a very deliberate decision around succession planning, where we knew some staff were approaching retirement age, and there was effectively not a particularly robust plan. So that's where we created the cadet role. And that cadet's been with us for a year. They'll have close to another year of direct handover with the individual, and then they'll be able to take over the role. So that has worked quite well. Would I have liked more time? Absolutely. And we're actively talking about succession planning for some of our key roles, and also ensuring that those people are valued in the organisation and see that they have a career pathway and enjoy their work here to keep them with us. But in terms of project lead, in terms of project delivery, 3 project leads in 3 years. In terms of manager of our asset manager function, 2 people in the last 3 years, and we're out recruiting again. Very dynamic environment, and people are expecting modern systems and modern ways of working. So a lot of our changes are actually pull, as in addition to a bit of push as well. So.
And in terms of your key staff, are they all employees or any of them contractors?
So none of our key staff are contractors. What we highlighted is some of our key knowledge sits with contractors. And that's particularly around our electrical standards and SCADA and things like that, and that would be a bit of a work in progress moving forward. But in terms of our direct operations and our internal consultancy sort of engineering team, they're all staff. We do rely on consultants for specialist work, but so I don't think we have any particular risk there.
Thanks, Stephanie. Well, any thoughts on this one? Jackie? More?
Not really, but I just
Moment.
I did actually wonder if, with this asset register, if ratepayers, is that going to be information available to ratepayers?
So all of our information is available to ratepayers or through anyone in New Zealand, should they wish to see it, through the Official Information Act. We normally wouldn't thrust the asset information system on an individual
And if
It's
we
like-
went looking for it, will your technology be upgraded to a point where we would be able to access all that? Just like we can with Riverflow and...
Yeah, so the vision is that people will be able to use the technology to let us know of problems. So the technology can already deliver to the community, just like our stock app at the moment. You can see a problem with your scheme, take a picture of it, send it in. That will then enter a workflow in enterprise asset management, so it can be approved or not approved. And so we really improve the current situation where someone rings the switchboard, gets put through to someone who may or may not be there, then someone goes and visits them. They don't get the address or the location right because it's really tricky on our rivers. Where exactly are you? To actually take a picture of the problem, get the GPS coordinates, go straight into the system as a potential piece of work, can be approved right there if it's a low value, easy thing, or can be programmed at a later date. So they're the sorts of things that we envisage can occur, and the improvement in the experience from the ratepayer or the community in actually engaging with us. So,
Thanks, Jackie. Thanks, Chris. Neil.
Yeah, thanks, Chris. A very useful overview, and it sort of plugs a few gaps in our knowledge, and it's quite influential on where we want to jump. What I was pleased about was to see you've identified at 6.1 to 6.5 the reviews that have taken place,
yep.
And that's very helpful. I wonder if where to start on this. I think from our perspective, from my perspective, the thing that would be useful instead of doing an audit or review, which is adding pile upon the pile, I wonder if we could have a slight expansion of each of those reviews, and you've done a good process there, identifying your progress along the road as one. What were the objectives, etc.? What was expected out of each of those reviews, and almost if you like, a creeping line that says we're up to, here's what it's set to do, and you've almost got it there with your little colour graph. We are 70% along the road to completing that.
Yep.
So if we have that for each one of those, we can cut short on any external scenario, but we just have, say, quarterly or 6 monthly update on each of those areas. And I wonder whether we could add to it because you highlighted it in your paper, is the asset, the capital program,
yep.
and the problems, etc. there. It would be useful to have a separate section, number 6, you've got 5 there, let's call it 6, is your capital, progress on capital spending and development. And finally, number 7, which is they're all inputs into the system. And I know, having sat around the table and got into a serious discussion with your predecessor in 2016, where it was clearly obvious that we had a moribund asset management process, and you've identified that. And told her everything was just fine and we're doing brilliant work, when I knew they weren't. So I wonder if, from my perspective, it's delivery at the service level. So we've set ourselves some objectives to say how, and I didn't use it, but I will, the stormwater system in Napier has got a 1 in 10 service level, if you like, expectation. Where are we on it? We know that's not sufficient. We want to get to 1 in 50. How do we get there? So the roadmap. So if I had that from a finance and a risk perspective, if I had progress on your reviews, progress on your capital, and then finally all this is aimed at achieving our service levels, and this is where we are. One pager would almost do it, that captures your progress in those sort of things. That would be, from my perspective, that would be more than sufficient to be satisfied that there's this really good progress going on.
Okay, so thank you. I think that's really helpful. And again, just we're much more enriched now than we were prior, just knowing what's been going on. So unless there's a question specific here, what I'd like to do is move it to the next stage so we can kind of, the committee can make their decision, or have it as a quick discussion. So really appreciate that. Okay, so then we'll move to, are we receiving your report or anything? Yeah. We're receiving it. I'll just be very wary of taking on some recommendation. What are we doing? We're just receiving it?
I'll move that we receive it, Chair.
I'll second.
Thank you. Well, thank you, Will and Jackie. Someone knows what they're doing here. And then we'll go to our item 7, which is our enterprise internal audit plan, which, of course, this is a key item of. So we've gone over your report prior. 2 out of 3 ain't bad, basically. And we had that discussion a good few months ago now. So would you like to quickly talk to your paper if there's anything new in particular, and or with what you've recently heard?
Sure. So we've, as you mentioned, we already landed on 2 of the 3 audits to be undertaken through the Enterprise Internal Audit Plan for this financial year we're now in. And there was some debate whether we look at the asset management or the health and safety. The recommendation in the paper is based on information that has been provided around the asset management system, is that be deferred for a couple of years until we're at such a point where we can get assurance that what has been implemented over the last few years is fit for purpose, and that we do an audit of the health and safety management system, or the health and safety management framework. The framework has been benchmarked on a standard that's now has to be moved because it was an ACC, what was it called, workplace safety management practices. So that standard's now not been updated. So the health and safety team have to pull their framework or their management system into another external standard that is recognised by WorkSafe. So there's a couple of options. There's ISO standards. There's other different types of frameworks. So that basically the review can serve 2 purposes if we put it into the internal audit plan. The first is to provide some positive assurance to the FARs that what is in place, the structure that is in place, because there is structure in place that was benchmarked on the old standard that we used, is still fit for purpose, and that we can look at some of the documentation and the practices and processes and procedures that happen out the back of that. And also to allow a gap analysis between whatever standard that is decided to benchmark the health and safety system on, and that provide a gap analysis, a bit of a spider web as to what areas we need to potentially put a bit more structure or discipline into. So that's the recommendation, is that we now pull that audit back in.
Thank you. And some of that's reflected through those various other risk reports that you're obviously party to. It's interesting, and again, reflecting on this new information we have from Chris's team, in that if the council hadn't inquired or made the necessary investigation or had comfort that things were running well in, let's just say, a flood event, questions will be asked of us as a council. And in health and safety, exactly the same. We have recently had flood events, and you've had a lot of attention for various reasons on your particular area, Chris. That's fine. But it's probably also worthy just noting as a board / a council, our obligations under the Act for things health and safety. And Stephanie, I guess you've got some expertise here, just to help us inform us, because basically, colleagues, our decision here is going to come down to weighing up the information we've had today, and then what we'd like to pursue as an audit, onerous or otherwise, but under a risk matrix. That's what we're here to do. But I'd ask James if you just remind us as if we had our full council here, our obligations, particularly with something's changed under the ACC that you've described, risks to us of this health and safety area, which we think we need to have a look at.
So look, as the paper notes, there was a review of health and safety and our maturity in this area in 2018-19, which resulted in a number of recommendations which we have implemented, and we've come a long way in terms of going from a part-time contractor, external contractor, to 3 dedicated health and safety staff, and they have a program of work which is now comprehensive and was subject, I think, to the last meeting of this committee, where you saw the annual health and safety plan. And so in terms of the recommendations from the previous audit, we've got those well covered off, and I think in terms of our maturity, the function, we've come a long way. I think now is timely, however, to check that there are no gaps, that overall we're now fully meeting our statutory obligations, which have evolved somewhat during that intervening period. So there has been some legislative evolution in health and safety. There's been some case law arise from health and safety incidents, and while we continue to remain abreast of those, and there has been this change in terms of WorkSafe's recommended framework that we're now working through, I think we are at a point now where it would be useful to check in that there's any further tweaks we need to make, or are we broadly on top of things. In terms of the sort of the basic obligations, legal obligations on council for the health and safety and wellbeing of our staff, we do have the appropriate policies, protocols in place, and we continue to refine those and look at them. More minor things such as the way in which we support our lone workers in the field has been identified recently, that we have some inconsistencies in terms of how that's managed across the organisation. Not gaps, but different parts of the organisation are using slightly different processes. So that's currently subject of work to standardise. So there are, I guess there are constantly opportunities to ensure that we're improving, which we're continuing to do. So just to assure the committee that it remains, top priority for the executive team. It remains a constant focus. The resourcing in there is strong. The work is comprehensive, but having an external view, checking that we are working to the most up-to-date, the most accurate framework, and we're covering off each and every statutory obligation we've got, I think would be a useful thing to do at this time.
Thanks, James. Just one other, this improvement register, because our paper says an intention to basically think about it. Can we harden that up a wee bit? But this affects where I'm going on. We do the works audit or the asset. Under the 5 reports, you're working on a constant improvement register.
Right.
Can you see that?
So
I'm just how far down the track is that? When can we see that?
I'm going to throw to Helen here. Are we talking about the
end of Chris's paper?
So my paper. So what I suggested to the committee to help with visibility is that we can take all the recommendations out of those reviews and put them into a summary document to provide visibility. So precisely what
Neil was describing.
Councillor Curtin asked for. That was a recommendation. So you could see what was happening. You could see progress that was what was happening. And you could see that things were either trickling along or not.
So I'm not going to change it, but we've already received the paper actually. But if that was more solid words, if you like, and commitment, let's say by the time it gets to CNS, is that quite possible?
Well, we've got the opportunity in this next paper to put those.
Oh, true. Okay. All right. Comments or thoughts about what you've heard, particularly around health and safety? I mean, I'm hearing from the CE, very key, very important, but it goes without saying the most important part of this organisation is our people. And of course, our obligations as governors. But Stephanie, from what you've heard, any thoughts?
Yeah, I have a couple of queries in terms of if the last review was done in 2018 or 19, what standard would that have been based on then?
So that's a very good question. I think it was the the ACC one, which aligned to our premium deduction that we got from meeting certain standards, which is that.
Yeah, the health and safety management system has been developed, the structure of it has been developed on the WCMP program. That's now not been updated, so that is the whole, we need to decide on which framework or management system we are now going to base that, the development and the principles and practices of the health and safety system on. I think the couple of options is ISO 45001 and there's Safe Plus. Safe Plus, thank you, yeah. Yeah, so
But I
I
think
guess
the
it's
answer
just,
to your question, Stephanie, is that it was the WSMP back then.
Because my confusion a little bit is that my understanding is that regime finished in 2017 and the new standards from ISO and Safe Plus were more 2018. So I'm a bit concerned. And in terms of a bit more background, the reason for that was because the ACC regime didn't fit with the new health and safety legislation, which came in 2016. So I guess to cut to the chase, I think it's very important to make sure that we do have an audit on this.
You're in favour of that?
I'm in favour of it because if we haven't had the right standards being reviewed or used as a baseline review since they were changed in 2017 because they were at least already 1 year out of date in the legislation.
Yes. All right.
I think it's very important that it happens.
Absolutely agree with you. I guess the comfort I was trying to give the committee is we haven't stood still in that period. And
No.
It has been a process of continuous improvement, but I think it is now overdue to check that we are working to the appropriate standard.
Okay. Anybody else? Jackie, Neil? Really valid point. Thanks, Stephanie. And just that conversation there, it sounds like some fingernails on the blackboard to me. There's some things out of alignment. And it's horrible for an audit type person. So, Neil, you're comfortable. So, given that and this, the paper, how do we do this? We've already passed some of those resolutions. We're doing.
We haven't for the next, this current paper, have we?
Yeah,
We've moved on to the audit paper.
2.3. Yeah, we're on the Helen's paper.
Yep.
And have we passed those other ones, or we just?
We did, yes, we did last time.
So I'm moving the recommendations. Which one am I moving?
So we're
now?
confirming the internal audit plan, which
Yeah.
includes data and analytics, organisational change, health and safety,
Yeah.
those three. And,
Okay. I just thought we'd already resolved those, but okay. 2.1.
And then
recommendation.
I'm suggesting, Mr. Chair, picking up on Chris's recommendation, that the Finance and Audit Committee receives an asset management and service delivery improvement report on a regular basis.
That's item 3, recommend 3.
Yep.
A new recommendation. I'm comfortable with that.
Chris, is that?
Yep, so I'll have a discussion with Helen about whether it's separate or integrated, but it'll be the same information.
We could possibly integrate it with our issues and actions.
Yeah.
Well,
dashboard.
you report on a regular basis, either to FARS or to most likely corporate strategic.
Improvement.
Do you want to pop it into that
Asset management.
framework? Or?
Yep, so I'll take it offline and just work out the best way to do it, but there's definitely a commitment to a regular report outlining the key objectives and activities, and so you guys can keep track of what's happening, so.
That's great. So new recommendation. So we're agreed as 1, 2, 2.1, 2.2, 2.3. Neil's proposed a new recommendation. Just read that again for
It
Anne-Lee.
receives an asset management and service delivery improvement report on a regular basis, whatever that may be.
It's the improvement register, which is referenced in the report. Everyone comfortable with that? You've moved that. I'll second that. So we've got now recommendations there, plus that one there. I'll move those in totem. I was about to ask Susie to second it. Stephanie, thank you very much, and thanks for your contribution and knowledge in that space. And really appreciate it, and kind of great, kind of not a compromise, but just the communications and knowledge actually has got us into a good place, I suppose. I'd say. By the time when again this gets to CNS, hopefully you'll be able to talk to what that might look like when the FAR's 24th, 3rd or 4th. Even if it's a verbal,
Yeah,
just
well, yeah, that's
to
fine.
enrich everyone. And I think you'll find that satisfies a lot of concerns. Okay, thanks very much, Neil, for that contribution. Yeah, that's good. What are we on now? Item 7.
Data analytics.
Oh, data analytics, yes. G'day, mate. Welcome back.
Hello.
Go ahead, the floor's yours.
Okay, so we've got the data analytics audit report. It's the 5th year that we've done one of these, as approved at the committee last year. The change from the approval that went through the committee was to do the audit report on the period from the 1st of June last year, 21, to April 22, given that we'd put in a new financial system. It seemed a little bit pointless to do it on data included in the old financial system. As with previous reports, one of the points that I'd note there that it is usual to get a number of duplicates of where bank accounts or addresses are the same between suppliers and employees, just given the size of the area around here. That with 3 main high-risk items that came out of there, all of them were reviewed. Well, all of the stuff in the report was reviewed by staff. No major concerns that came out of any of that. A couple of points that I would note there, that from those red reviews, one of them, we want to improve on our purchase order training around people, and that's part of the putting in the new system to make sure that people understand when they should be doing the purchase orders and the approvals that they should have. And the other one was just around where there may be any perceived conflicts of interest or anything like that, to make sure the staff think about that and get one-up approval, and we'll incorporate that into some of the fraud training that we're looking to roll out to the rest of the staff.
Thanks, and thanks very much. They're very important, these particularly, but less revealing now that we have computerisation and the way we can trace transactions, etc., and a procurement policy which is by and large adhered to across the organisation. There is no headlines there or things other than the 3 that you mentioned that I could see that are overly concerning, or any material items or emerging items from that report, in your opinion?
No.
James, all okay? Good. Anybody else on that? Okay, well then, you did an excellent job there, so I'm going to move that we receive your report. Again, once I find the appropriate document. Excuse me for one sec. Decision-making process. Okay. The right one there, James? Yeah, 2 more audits, basically. Data analytics, I found it now, excuse me. Right, so recommendations that we receive and consider the data analytics audit report, staff report, which we have. I'll move that. Will seconded it. Thanks very much, Will. Cheers, and thank you to yourselves and Crow for assisting. Okay, item 9. Is that Helen back?
Yes.
Music stops, so grab a chair.
I'll stay up.
Thank you. Yes, this is just, this paper just really highlights that given the disruption last year, we only had 2 audit reviews on the plan. Both of those are now closed out. You've just had the last report from the second one. We had that retained capacity, but we never actually used that in the last year, primarily because of the business disruption that was going on with COVID and stuff. Turnover and things.
What's that capacity again? Is it 40?
It was 40 hours, yeah.
The normal one's 20-ish, isn't it?
Depends on the type of audit, really. So, for example, fraud management would have been would probably be around more than 20 hours. Data analytics is probably less, but it takes quite a bit of time for staff, the data analytics, because they have to actually review any exceptions that, and then pull those transactions. So,
Okay, so basically it's a status update here. We've got a blank there. Nothing's particularly changed. What will change is pursuant to the conversations we've just had, the next version of this.
that's right. This will be replaced with the new plan that was just signed off on.
Updated, and colleagues, there is retained audit capacity there. We did that quite deliberately. Keep pressure off staff and keep something up our sleeve if necessary. But again, that larger overall assurance chart is very, very useful. And I think I had a chat to the CE earlier, and there's some items that will add to that, such as the items that Mr. Dolly was speaking about, which just shows there's a lot of work checking that we're doing the right job within the organisation. It's really helpful.
I think one point that's worth letting the committee know is that there is operational audits that happen within the management systems. For example, the quality management system has operational audits against processes that are documented in that system. The way the framework is written is if there's any high findings at an operational level, they are then escalated through to the risk and assurance team so that we can either adjust the risk reporting or escalate through the audit program.
That's right, and the magic here is bringing all those threads together. I do compliment everyone on only having a 69-page agenda this time and a lot of attachments. I'm fully hopeful we'll get that down by 50% easy, but that's a work in progress. Thanks, Susie. Okay, so thanks very much. So I'll move the recommendations on your report, recommendations 1 and 2, which are basically receiving, considering, and then reporting up to corporate and strategic. Will you second those again? Thank you. Passed. Thanks very much. Now, all further exciting audit matters. We've got the annual plan audit plan for the 2021-22 annual report. We've got a bit of information there. What are the pertinent items we need to discuss, understand, and acknowledge from that?
I think, moreover, this is just an update to say when the audit's going to be commencing, running through October, with a plan to clear the audit report in November this year. Hopefully we don't have the technical delays that we had last year that took us through to June. We have our new auditors in place in St Young. We have had a few meetings with them. They did an internal audit, or an interim audit, just before the year end to get a bit of a process analysis. We don't envisage any problems going through the audit, and we're starting to get quite a bit of engagement with them.
Thanks. I know they're also HBRICS auditors and Food East's auditors too, so hopefully that's somehow of assistance. Just one question from me. If in fact we do have the delays similar for some reason that we did last year, are we, as much as we can, be more prepared to deal with them, acknowledge them, or are we just at the behest of EY?
I would hope that we wouldn't have them with EY again like we did last year. I think there was a real, because of trying to get the expertise, COVID in there with Audit New Zealand, that was what really created the delay in there. We're not expecting to have that sort of level there. All audit firms are short of staff at the moment, but we've got this time locked in to go through it. We've had early engagement with them, so.
Yeah, I know. But like everyone, I think everyone's a bit tired of they're short of staff. They've been short of staff for 2 years. They've chosen not to do some things about it or change their models. But the cost of these audits have all gone up. So
we will be keeping close contact with EY to ensure that the audit goes through as expected, and if there's any issues that are arising, that we're dealing with them fairly quickly.
Okay, any thoughts, comments, anybody? Okay, thanks. So again, Will, thanks for moving that we receive and consider that, which we just had, and Stephanie, you've seconded it. Thank you. That concludes the public-facing business we have today. I move, as per the agenda, that we go into public excluded. Jackie, are you seconding that?
Sure.
Jackie seconded that. In favour? We are. Can we please move into public excluded?